Hello everybody. At this time we are talking about an operating lease. An operating lease allows a business to use an asset without incurring the high expenses involved in purchasing it. It's a contract that allows for an asset use but doesn't convey ownership rights. The business that leases the asset is referred to as the lessee, and the business that loans it under a lease is the lessor. The responsibilities of each party in the agreement are spelled out in the lease contract and documents, but the lessee must generally maintain the asset to ensure that it remains in operational condition less any normal wear and tear. And then when an operating lease makes sense, the first, you're scaling or pivoting. If your lab is expanding quickly or shifting scientific direction, leasing gives you the flexibility to adjust your equipment strategy without locking in long-term commitments. And then second, your tech evolves fast. In fields like genomics, cell therapy, or bioanalytics, equipment becomes outdated quickly. Leasing lets you return or refresh at the end of the lease term, so you're not stuck with a legacy system. And then third, you're managing limited capital. Leasing minimizes upfront costs and spreads out lease payments, preserving working capital for hiring, R&D, or clinical milestones. And then fourth, you're navigating short-term projects or grants. For labs with time-bound funding or trial-based needs, leasing aligns equipment access with the lease period and avoids the burden of offloading equipment when the project ends. And then how operating lease works. In common with finance lease, an operating lease lets you rent the asset from leasing company for the duration you require it. The main difference lies in the fact that an operating lease covers only a portion of the asset's total useful life, meaning you pay a lower central fee because it's calculated based on the difference between the asset's initial purchase cost and its residual value at the agreement's end. You enjoy complete access to the asset for your required duration without the obligation of managing its disposal or recovering its residual value. And then we move to characteristics of operating lease. Key characteristics of an operating lease includes the first about short-term. Operating leases are typically shorter in duration compared to the useful life of the lease asset. They often cover a significantly less period than the asset's expected economic life. Second, tax benefits. Operating lease payments are usually deductible as an operating expense, providing potential tax benefits to the lessee. And then third, no ownership transfers. At the end of the lease term, the lessee does not have the option to purchase the asset at a predetermined price, as in common with capital leases. Instead, the asset is returned to the lessor. And then fourth, flexibility. Operating leases offer more flexibility to businesses as they allow for easy upgrades or replacements of assets at the end of the lease term. This is particularly useful for industries where technology or equipment rapidly evolves. And then fifth, maintenance and upkeep. The lessor usually retains responsibility for maintenance, repairs, and insurance of the leased asset. This can benefit the lessee as it reduces the burden of upkeep costs. And then we move to capitalizing an operating lease. If a lease does not meet any of the criteria, it is considered an operating lease. Assets acquired under operating leases do not need to be reported on the balance sheet. Likewise, operating leases do not need to be reported as a liability on the balance sheet, as they are not treated as debt. The firm does not record any depreciation for assets acquired under operating leases. However, if a lease does meet any of the criteria, it is instead considered a capital lease. A capital lease is treated differently from an operating lease. Instead of being treated as an operating expense, a capital lease is considered a financing expense. Therefore, we need to adjust the lease expense, depreciation expense, and interest expense numbers to account for this shift. This will have an effect on operating income, which will always increase when these expenses are recategorized. However, it will not have any net effect on net income, as the change in numbers will balance out. There are two methods to capitalize operating leases. The first, the full adjustment method, and second, the approximation method, And then we move to the differences between operating lease and finance lease. The main differences between operating and finance leases include about the first, ownership. With an operating lease, the lessor retains ownership of the asset. With a finance lease, ownership of the asset transfers to the lessee at the end of the lease term. Second, accounting treatment. Operating lease payments are expressed on the income statement. Finance leases are capitalized on the balance sheet. And then third, lease term. Operating leases usually have shorter lease terms than finance leases. And then fourth, about risks and rewards. With an operating lease, the lessor assumes more of the risks and rewards of ownership. With a finance lease, the risks and rewards transfers to the lessee. And then we move to challenges of operating lease. Operating lease compared to a finance lease or capital lease comes with several challenges to navigate through, and some of them include about the first, no equity. The lessee gains no asset ownership or financial stake in the lease asset, as lease payments only cover its use. This limits potential financial benefits from owning the asset in the long term, as would be the case in a capital lease or financial lease. And then the second, longer term leases might cost more than buying. In some cases, longer term operating leases can end up being more expensive than purchasing the asset outright. Businesses should carefully evaluate the total cost over time compared to ownership, especially when considering finance leases or capital leases. I think it is enough. Thanks for watching.